Today, we're going to be taking a look at each of the FAANG stocks and determine which one is the best value in the market as of today. So we're going to take a look at Meta, Apple, Amazon, Netflix, and Google. We're going to quickly take a look at the last several years worth of financial information on them, and then we're going to come up with an intrinsic value calculation based on my assumptions going forward for the company. So hopefully you get some value out of this video. Let's just jump into the first stock, and the first stock is Meta Platforms, ticker symbol META. It starts out the FAANG, the F, which used to be Facebook, but obviously now it's Meta. Let's first take a look at revenue and net income for this company over the last 10 years. You can see revenue, top line growth going from $5 billion all the way up to $118 billion in 2021. Net income has also grown very, very quickly, going from less than $2 billion in 2012 all the way to about $40 billion in 2021. Very, very impressive overall. Now let's take a look at some margins for the company. Gross margin is in blue, and then operating margin is in white. You can see the gross profit margins have grown over time, going from 77% to about 80% last year. Operating income has also grown quite a bit, from around 10.5% all the way up to about 40%. However, that has been going down over the last couple of quarters because of the metaverse. They're putting a ton of money into their R&D, so they're expensing a lot of stuff they're doing for the metaverse, and it's bringing down their operating margins to less than 30% as of the last quarter. All right, so let's move on here, and let's talk about return on capital for Meta. You can see it's also grown from about 3.8% all the way up to 33% as of last year. So that is really, really good. I would consider anything over 10% to be solid. Anything over 20% is fantastic. Once you're getting over 30%, that is really, really impressive indeed. Now, their net income, their operating income has dropped over the last couple of quarters. So this 33% is no longer. It's going to be considerably lower than that this year, and probably going forward as they put more money into the metaverse, which will reduce their net income overall. So now let's talk about valuation for Meta. And with all these valuations, these are just my assumptions. These are not advocating to go buy or sell any of these stocks. Always do your own research. These are just my assumptions. All right, so first let's take a look at sales for this company. I'm being very, very conservative here. I'm saying pretty much flat on the top, $118 billion. Again, they were about $117 billion last year, so pretty much no growth for this year. But then after that, 14%, 11%, and then 13%, and then 12% overall. I think operating margins are going to dip. I think they're going to go down to around 28%. So based on this information and a multiple of 16, which is a pretty low multiple in my personal opinion, I come with an intrinsic value of about $200 for this company, and it with an IRR of 10%. So that is roughly a margin of safety of almost 35%, with the stock trading here around $130. If you want to stick around till the end of this video, I also talk about the risk for each one of these stocks overall. All right. Next up, let's take a look at Apple, ticker symbol AAPL. And you can see revenue has just grown really, really solid over the last 10 years, 156 billion all the way up to 365 billion last year. Net income has grown as well, from 41 billion all the way up to about 94 billion last year. So next, let's go take a look at some margins for the company. Gross margins, they were at 43% 10 years ago, and it kind of dropped into the mid to high 30s, but as of last year, they're around almost 42%. Operating margins have been anywhere from 35 down to 24%, and then last year was around 29%. Return on capital for this company, absolutely phenomenal. They've been in the 20s, 30s, and even 40s and 50s actually. So 54% last year, which is absolutely incredible for a company. That's hard to find. So if you've been an investor for them over the last year or so, it's been good for you. Let's put it that way. So we take an intrinsic value for this company. I think sales, it's going to be around $390 billion this year. And then you can see the growth numbers going out the next 5 years, landing around $500 billion in 2026. And I think operating margins will land around 30%. about 5 years out from now. So based on that, I come with an intrinsic share price of about $127 on a multiple of 22 IRR of 10%. So I think the stock right now is 15% over what I believe the intrinsic value is there. And something I should point out too, real quick, is when I'm valuing companies, what I'm essentially is doing is projecting out operating income for the company and then discounting it back to today based on a multiple for the company, but then also based on internal rate of return that I would like to get for a particular stock. And if you're curious on how to value companies, if you don't know how to do that, I do offer that through my Patreon. I have different valuation templates in there. I show you how to use my workbook if you're interested. You also get access to my Discord. I do have stock analysis posts on there, and then I have exclusive videos as well for my Patreon members. And I'll put a link to the description below if you want to go check that out. All right, so let's move on. Let's talk about the next stock, and that is Amazon, ticker symbol AMZN. And you can see the revenue here has been incredible, going from $61 billion all the way up to $469 billion last year. And net income for a few years was negative. I mean, they were all the way down negative 39 million. But as of last year, they were around $33 billion. So they've had a lot of growth going on over the last several years. It's also why they've been trading at a very, very high multiple because of that growth overall. If we look at margins for the company, gross margins have gone from 24% all the way up to 42%. I mean, they've been growing almost year after year, which is really incredible. Operating margins as well, they've gone from around 1% all the way up to 5%. The margins for these type of businesses are very, very compressed. If you look at Walmart and some of those other retailers, they don't have a lot of wiggle room overall. Now, Amazon is fortunate enough to have AWS, which has incredible operating margins, some around 30%. So that is really helping inflate their operating margins overall, and they should continue to grow over time. If we take a look at return on capital for this company, it's been anywhere from 5% down to less than 1%, and then last year has been around 9%. But this company puts a lot of money back into the company itself, acquiring other companies. And overall, their return on capital is not as good as what we see from these other FAANG stocks. Return on equity has been really, really good. Return on capital not as good because of all the investments they've been doing overall. Now, we took a valuation for this company, I think around $520 billion for sales this year. You can see the growth on the right-hand side here. And as far as operating margins, I think they're going to continue to grow. I think they're going to get up to around 10% about 5 years out from here. So based on that and a multiple of 25, I'm coming to an intrinsic share price of around $130 here today. So I do believe there is a margin of safety of 9% right now for Amazon based on current prices. All right, so let's go on. Let's talk about Netflix, ticker symbol NFLX. You can see the revenue here has also grown $3.6 billion all the way to almost $30 billion last year. Net income has grown from 17 million all the way up to about $5 billion last year. And I hear a lot of people talk about Netflix and saying, oh, they're not profitable. Yeah, they are profitable. For a long time, they were not, but they are a profitable company. All right, let's go take a look at margins for the company have been improving literally year after year, going from 29% all the way up to about 42% last year. You look at operating margins going from 4% all the way up to 20%, and the company has said they want to be in the 19 to 20% over the next few years. So let's go on and let's take a look at return on capital for this company, and it has grown really well, going from around 4% all the way up to 18% last year. So that's looking very good. Now, intrinsic value for the company, I come with sales about $31 billion this year. So not a whole lot of growth. And then after that, we're ticking up about 10, 12, 13, and then 12%. Operating margins, I do believe they're going to get up to around 23%. I think there's a really good chance they could be around the 25% range. I'm saying 23%. Based on that, and a multiple of 18, I'm coming with an intrinsic share price around $280. So that is, right now, the stock is trading 4% above what I think the intrinsic value of Netflix is currently now based on these assumptions and this valuation method. All right. Next up, let's go talk about Google. Ticker symbol GOOGL. Now, keep in mind that Google trades under the parent company Alphabet. They do have a couple of different ticker symbols. So this is ticker symbol GOOGL. Just might want to make that clear. You can see revenue has grown from $50 billion all the way up to $257 billion, which is absolutely incredible. Net income has grown from $13 billion all the way up to $76 billion last year. And if you guys are curious where I'm pulling the financial data from, or even where these graphs are coming from, this is coming from Ticker Terminal. This is a platform choice that I use. I would not recommend it or be an affiliate of them if I didn't actually believe in the software. I think it's a phenomenal software. I think it offers more than any other platform that is out there personally. They have a free version, then they have some paid versions. I'll put a link to that down and below too if you want to go check them out. I am an affiliate of them, just want to let you guys know that, but I would not recommend anything I do not use myself. All right, so let's go on. Talk a bit more about Google. You can see the margins going from about 62% to about 56% for gross margins. So they have dipped. But they're still fairly consistent and they're still solid for Google overall. Now, as far as operating margins, around 30% 10 years ago and 30% last year. But in between, they've gone all the way down to 22%. But currently, they're sitting around 30%. Return on capital for this company, also very good. Been 17 down to around 14, all the way up to 27% last year. So definitely a theme here. The return on capital for all these companies are really, really good. Amazon is the worst, but they've been putting a lot of money back into the company as well, which is also hurting their net income, which is also hurting the return on capital overall. But overall, very, very solid. Very, very solid. All right. So now let's talk about valuation for Google. I think they're going to be around $290 billion for sales this year. You can see the growth over here. And then you can see operating margins, I think around 28%. The company, like we saw before, has been 22, 25, 28, 30%. I think 28% is pretty conservative for them. So based on this information and a multiple of 20, I'm coming with a share price of $120 for intrinsic value, which is a 17% margin of safety as of today's price, because it's trading under $100 a share as of this video. So that looks interesting there. So let's do a summary of these stocks real quick, and I'll kind of give you kind of my risk factor on each one of these stocks as well if you're interested. So you can see here we have Meta, we got Apple, we got Amazon, we got Netflix, and then we have Google on the side here. You can see we got sales growth, and that CAGR is compounded annual growth rate. So that's the growth rate per year based on sales and then operating income. What I think the market will pay for the company, say 5 years from now, we got our intrinsic value, current stock price, a margin of safety, and then I'll talk about the risk factors for each one of these stocks here in a second. So when I'm looking at a multiple for a company, I'm kind of looking at risk overall. So you can see Meta, for example, I have a 16 multiple, but you can see that the risk factor is high. And the reason why I say this is a high risk for this stock is simply because of the money they're putting back into R&D trying to build out the metaverse. We have no idea how much it's going to cost. We don't know if it's actually going to work or not work. We can see operating margins taking a massive dip, going from almost 40% down to 29%. Now, if you look at a lot of legacy businesses within Meta, specifically Instagram and Facebook, those operating margins are in the high 30s, like 38, 39%. But the R&D expenses that they're incurring right now are going to hurt operating margins. Hopefully metaverse pays off, but this is assuming with no metaverse at all. But I do still think it is high risk, and that's probably why it has the highest margin of safety as well. Now, companies that have a low or medium risk overall, I think they should be trading at a higher multiple. I think the market is going to be willing to pay a higher multiple for the company, and multiple is extremely important for a stock. If they're trading at a multiple of 15 versus 50, that can really make a big difference on the stock price overall. Apple, I have them at a medium just because I have a hard time believing they're going to be growing very quickly, especially the growth that we've seen in the past. They don't have as many revenue streams as, say, like an Amazon or a Google, for example. But I still do think their capital allocation and the money that comes back to the shareholders very great value. And so a multiple 22 makes sense. Amazon is the highest multiple of this group. I also think it's the lowest risk level along with Google. I really misunderstood Amazon personally when I started investing. I looked at Amazon's balance sheet, say compared to Meta, and Meta was flush with cash where Amazon had barely any cash. But Amazon is one of those companies that is an incredible capital allocator by taking money, putting it back to the business, buying other companies, and building their company out. It'd be most people be blown away if they look at their 10Q or their 10K, see all the companies that they own. It's usually about 2 or 3 pages long. And a lot of the companies that you interact with, you probably don't even know those are Amazon companies. And I believe they just recently put out there trying to buy iRobot, those little robot vacuums that kind of go around just to add to all the companies they already own overall. So the two stocks I think are highest risk is Meta and Netflix. And the reason for that for Netflix specifically is that there's a lot of competition with streaming. Now, I think people, have the availability to buy Disney, Netflix, they can buy Warner Brothers, they can buy all kinds of different streaming services that are out there, but there's still a lot of competition. And Netflix even recently has had some issues with subscriber growth. Now, this last quarter looks really good overall, but there's a lot of money that's put back into the company in order for it to grow. So I do consider it probably a higher risk than some of the other stocks that are out there. But obviously, everybody has their own opinion about this. So I'd be curious from you guys. What do you think about these valuations that I have here for Meta, Apple, Amazon, Netflix, Google? Do you agree with these risk levels over here? So I'd love to hear from you guys down in the comment section. Thank you so much for watching this video. I really appreciate it. If you haven't already, please go ahead and like the video. It really helps out the channel a lot, helps pushes this video out to more people. If you like this kind of content, I encourage you to subscribe to my channel. Again, I do have a Patreon if you want to go check it out, or you can access my valuation templates, Discord, and some other things as well too, which will all be in the description down below. Thank you so much for watching. I'll catch you on the other side. Take care and God bless.